Monday, November 3rd, 2025, Maneco 64, home of alternative economics and contrarian views. Well, we're going to look again at the Dow-Gold ratio, and we're also going to look at the gold to S&P ratio. And I think we are on the cusp of an acceleration of the financial or credit reset away from financialization or paper assets into hard assets. This is what these ratios are telling me, and it's telling me that the place to be is gold, silver, and hard assets, i.e. commodities. But before I do, just wanted to say that looking through the statistics for this channel, I see that like 40% of you are watching my videos, and I thank you for that, but you're not subscribing. So yeah, make sure you subscribe as well. If you're a regular viewer, it helps because my videos will show up on your YouTube page if you subscribe. And yeah, the other thing, and I'm guilty of it as well, when I like a video, I don't press the thumbs up. So make sure you do when you enjoy one of my videos. Don't have to enjoy them all, of course. And before we go into the Dow-Gold ratio and the gold S&P ratio, I just want to give a shout out to the Mises Institute. It's the premier institute, academic institute for the Austrian School of Economics, which is the complete antithesis of the PhD Keynesian economics that unfortunately we've been following for decades. Recently, I interviewed a senior fellow at the Mises Institute, Dr. Mark Thornton, excuse me, and we spoke about this new book, Hayek for the 21st Century. There's 100,000 of these that they will ship to you for free. I'm going to put a link in the description, and you can order one. So Friedrich von Hayek was one of the giants of the Austrian school. He was even awarded a Nobel Prize in economics. And the reason I'm talking about this is there's a stark example that I saw today in the real world of what the Austrians, and particularly Hayek, warned about the interference by government in the price mechanism, in employment policies, in the money, of course, and that's via central banks, and taking the gold anchor out of money, making it paper or fiat. There's all these fatal conceits, as von Hayek used to say, that the technocrats, the Keynesians, these PhD economists, they think they know better than the market. They think they know better than Adam Smith's invisible hand. And the stark example is a story that I just saw pop up yesterday, Sunday, in the FT, and it says, city bosses, and that means the City of London, warn on pay as minimum wage closes in on graduate salaries. Chief executives voice fears about impact on recruitment ahead of expected rise in budget. So what's going on here? We're seeing that interference by the state in the price of labor, i.e. Setting wages, minimum wage, is now become so extreme, and also other policies of how you should treat workers or employees, junior employees. And I'm not saying you should mistreat them, but you should leave it to the companies, to the private sector to worry about that. But what's happening now is that the minimum wage has been raised so much. And why have they raised it so much? Well, because government interfered in the money, right? And they've created massive inflation. And the minimum wage right now, which is they want to raise it by 4%, which is really even below the real rate of inflation. It is about, just over 12 pounds. And what's happening here is the bosses of the, let's say, accountancy firms, law firms, and other service providing firms in the City of London are saying that this is going to encourage young people not to go to university and take on massive amounts of debt to go and earn a minimum wage. They can just not go to university and go stack shelves in the supermarket and earn the minimum wage. So it just shows how disruptive socialism, or even just government interference in the price setting mechanism is. And there's no easy solution except to get government out, to abolish all these government controls of prices, price of labor, price of capital, i.e. central banking and fiat currency, right? The employment policies. There's a lot of other things that government is interfering with in the markets, and now it's backfiring. So these city firms are going to find it harder and harder to attract young graduates, because what's the point if you can skip 3 or 4 years of university and earn the same thing? Yeah, it's not going to be totally disrupted, because some people still realize that starting at one of these firms, your long-term prospects are a lot better than stacking shelves. But I think this is just a stark example of what happens when governments interfere in the marketplace. So back to the Dow Gold ratio. So a week or so ago, I spoke about the Dow Gold ratio, how there was a death cross. And the death cross was in relationship to the 7-year moving average, which you can see here. And every time the Dow Gold ratio, which basically is how many ounces of gold you need to buy one Dow Jones Industrial Average, it had crossed below that 7-year moving average. And every time 3 other times in the last 100 years or so, that signal a great unwinding of the previous credit bubble. And as you can see by this chart, I said that I thought the last credit bubble started after the '08 crisis. And yes, the Dow Gold ratio did rebound above that 7-year moving average, as you can see, back around 2012 or 2013. And it stayed there pretty much until recently, even though it dropped below that moving average back in 2020. We know what happened in 2020, of course. And then they came in and they threw even more funny money and borrowing into the system. And that's why the Dow rebounded above the moving average. But it's completely failed now. And the other thing that I noted the other day, because Friday, the last trading day before today, was the end of the month, and this is a monthly chart. You notice that we actually closed back below this trend line, which is really important. A few months ago, it closed below it, and then it rebounded above it, and now it's gone back below it. I think it shows that the trend is lower. And what does that mean? Well, it means that gold and silver, for that matter, don't forget silver, will outperform financial assets, i.e. Common stocks and government bonds and corporate bonds going forward. And I think we could accelerate a lot lower. This ratio can be quite sticky, but once it turns, it can move very quickly. It could be a matter of 18 months to 2 years, I would say here. It sounds a long time, but if you think in a matter of days and weeks, I think you're in the wrong game, investment game, or safeguarding your savings game. So yeah, I'm still convinced we're going to see this ratio back down towards 1 or 2 to 1, or maybe even lower, because ever since the early 30s, when this ratio has bottomed, it has been at lower levels, and when it has topped, it has been at higher levels. There's like a megaphone formation. So yeah, very bullish, I think. But there is another ratio which is really important too, is the gold to S&P ratio. It's the same kind of thing, but we look at it in terms of gold instead of the S&P. And as you can see by this chart, another monthly chart, gold, you could buy 8 S&Ps almost with an ounce of gold back in 1980. And then gold bottomed in terms of the S&P. You could only buy 0.185 back in the early part of this century. And then gold rallied strongly up until 2011. And it's been basing ever since, really. There's been a bear market in gold versus the S&P. But I think now it's turning. And the interesting thing is that in the last, I think it was back in April, it started taking off, gold to S&P, and then it came back down sharply, and it actually retested the breakout area, which is very positive technically. And now we're going back up, so we need to keep an eye on this. I think if we break through 0.7, that's very bullish, and that in of itself will also help the Dow to gold ratio, because I think right now it's one of the reasons the Dow gold ratio hasn't dropped even more, is because gold to S&P is still not clear, but I think we're getting there. And at what levels will, let's say, the Dow gold ratio be if we go 1 to 1? It's difficult to say, of course, but it's all relative, right? You'll be able to buy a lot more financial assets when that happens. And yeah, I want to emphasize that I don't believe having gold is the end all, but it's very important in this day and age where the system is teetering on the edge, the financial and monetary system. But eventually, it will be good to invest your money, real money, in, let's say, productive assets. But I think we're not near there yet in terms of value. I think you can wait, and that's my opinion, when it gets to 1 to 1 for the S&P. Yeah, I think there's still a lot of room as well. If we get to 8 S&Ps to 1, 8 S&Ps to 1 ounce of gold, that will be good too. It could go even higher. So let's quickly look at the markets this morning. It's 7:53 a.m. London time. So my American viewers are now back on normal time, not summertime or daylight time. You changed your clocks this past weekend. We done it the weekend before, so we're like 5 hours ahead now, London to the to Eastern Standard Time. And let's check out gold first, as we always do. Spot gold is at 4,024, up 21 bucks. I noticed overnight, late last night here London time, that gold dropped sharply on the open on COMEX and the futures. It dropped to 39.62. So it's quite encouraging that it's rebounding, especially on the Monday, because a lot of times we see gold being hammered or slammed overnight from Sunday to Monday, and it continues. And there's a story about the Chinese government implementing new VAT policies for gold. There's a lot of confusion about it. I'm not going to talk about it now because I'll be interviewing Eric Young, or AKA King Kong 9888, later on today, and he's going to tell us all about it because there's a lot of misinformation in the financial mainstream press in the West. People like Bloomberg and let's say CNBC and so on. So what about silver? Well, silver is doing quite well. I mean, relatively well. It's still not going gangbusters, but I think it's only a matter of time before we go back above 50. We're at 49.05, up about 40 cents. Spot silver, high's been 49.10, low has been 48.20. The stock market indices, we've got the Dow futures up 1/8%, S&P same kind of gain, NASDAQ 100 future, that's up 1/4%. The currencies are virtually unchanged, really, versus the dollar. And in terms of the bond market, U.S. Treasuries, the 10-year is unchanged as well. It's at 4.10. So yeah, we've gotten back above 4%. The 30 years at 4.67. Why has that happened? I think it's because in the last FOMC meeting last week, the Fed tamped down a little bit the expectation of rate cuts, especially for December. So the market's kind of concerned that the Fed wants to try to control inflation a little more, and that they're concerned about inflation. So that's it for now. With that, I'm going to wish you all a very good start to the week and a very good day. Take care. Bye.